financials, and you have completely exited your exposure to large caps and PSU banks. Take us through the rationale behind this move. And now that you have done this, how are you planning on playing this theme?
Thank you for hosting me. Yes, you're right. We've exited our large cap and PSU bank positions. We have been maintaining for quite some time that the large cap private sector banks are unable to match the growth levels that their valuations demand. When you're trading at 2 to 2.5, your growth needs to be above your ROE, whereas the large cap banks are hitting growth ceilings at about 16 to 18%. Due to a combination of factors, including a high base effect. To this level, we've seen that when they go above a certain valuation and we are in that valuation zone, there tends to be a period of time correction. Yes, the cyclical factors are in favor of this sector. We're expecting a sharp margin bounce back. The credit cycle continues to be quite strong, and asset quality remains quite pristine. But there are pricing pressures all across the spectrum in the space. Credit cycle is strong on the growth side, but there are pricing and yield pressures across retail and wholesale, with SME, which is a small part, the only area where they're able to protect margins. So in a bull market, we think that this segment or this sector, the large cap banks, will at best be market performers or probably underperformers. You may see some absolute price appreciation, but they are likely to underperform a rising market, which is why we've exited from that position. Our primary thesis in terms of the sector that we are most bullish on is consumption. The GST cut and the strong credit cycle also contributes to that high consumption thesis. So we reallocated that weight to consumption, on which we are significantly overweight.
So what are fair valuation multiples for private sector banks, given the fact that there is increased competition, but they are in a bit of a tactical upmove, cyclical upmove right now? You said that 2.5 times price to book is overvalued.
1.7 to 2 times is where...
So many of them are at 1.7, 1.8. Many of them are sub 2. So you don't think there is a valuation support?
Yeah, meaning those who are at 1.7 have lower ROAs. So we were quite enthusiastic when the sector was at 1.5 to 2 times. That's when the up move started. During the Middle East crisis. But now they've rallied. I think they've priced in the FY27 cyclical up move, because there is nothing to address the longer-term structural competition that is coming from NBFCs, from fintechs, on the deposit side. So again, the financials theme, we also prefer small and mid-cap banks, which are offering what we call growth beta. If the system growth is X, they are able to grow at 1.4, 1.5X. And that is one segment that we like. And NBFCs, we are neutral because they're also face valuation challenges. And some of the small and mid-cap banks offer better growth beta. And with the mid banks, valuations are also fairly comfortable at this point.
Seshadri, you mentioned PSU banks as well. Fair to say that the best of the PSU banks is now past them, considering the fact that they have already wrested market share from their private peers. Their growth they have also seen multiple quarters of steady growth, stable asset quality. But now are the valuations past what the market is already factoring in?
Yes, PSU banks face a tough FY27. Unlike the large private banks, they are facing the next 12 to 18 months. There are multiple challenges. The first is that there's a high profit base, a high treasury proportion in the base profits of FY26. So all of them are facing falling ROEs and very sluggish EPS growth. Secondly, if you take a 1 to 2 year view, we think that credit costs have bottomed out. They're benefiting from recoveries from some of the past, NPAs, which they're recovering from. Once that dries out, credit costs will normalize upwards. And then there will be, we think, some significant impact of ECL provisions which kick in from FY28. So, finally, they've all been operating on fairly thin capital basis because they are backed by the government rating agencies, and the market have been. But I think that period is coming to an end, and most of them will have to raise their capital ratios, which, as we know, their ROAs aren't great. Their ROEs are good because of low, high leverage. That story also may unwind in the next 12 to 18 months. So multiple pressures on the PSU banks. So while we agree that some of them are relatively underpriced with similar metrics as the private sector banks, but the next 12 to 18 months don't look great, which is why we are not taking a position there as well.
Seshadri, you look at the AMC space very closely. SBI Mutual Fund will also be coming out with its IPO very soon. Have you done any analysis, and how would it compare with the listed players? The large ones are HDFC, ICICI Pru. You also have a Nippon, etc., Aditya Birla. What are your initial thoughts on this IPO? And then if you want to tell us which stock is best placed in the AMC space.
No, we haven't done a deep dive into the upcoming IPO, while we do acknowledge that this is one of the strongest franchises. We are very bullish on this space overall. We've written a report some time ago, which our assessment is that the share of equities in household financial savings has moved up from 16 to 30% in the last 8 years. Last 2 years has been relatively stagnant. But we think in the next 5 to 10 years, this number will go even higher, just because the markets are stable. Fixed income yields are barely covering inflation, especially adjusted for tax, and the deepening of the equity markets will continue. So we are bullish on the entire capital market intermediary space. AMCs and wealth management are our preferred routes to capture this. We tactically move around which stock we like. We like all of them, but we tactically move around. At the moment, we've taken a view that, in a high beta market, preferably to go to some of the smaller, turnaround names rather than the big solid franchises at higher valuations. But you could pick any stock in this sector, and from a 2 to 3 year perspective, I think you will get outperformance.
Pleasure having you as always, Seshadri. Thank you for sparing time and joining us on this very interesting analysis that you've done on the banking sector and the financialization theme.